There are many professional investors out there, each of which with their own personal views on diversifying your portfolio. In one corner, you have the likes of Ray Dalio and Howard Marks, who are big advocates for diversification, with Dalio encouraging investors to find solid investments with great returns that have as little correlation to each other as possible. In the other corner, we have the great Warren Buffett, George Soros and William O'Neil, who lean away from this concept, with Buffett once going so far to say that diversification is protection against ignorance. It makes very little sense for those who know what they're doing. With such heavyweights in either corner, it is important to understand where both sides are coming from. There are certainly reasons to fight for both sides, and in this video, we will discuss what diversification is, the ways that you can do it, and whether or not you should be diversifying your portfolio, as well as hearing from some of the aforementioned legends of investing. If you like this video on diversification, it would be much appreciated if you could like, comment, and subscribe to show your support and also help with the YouTube algorithm. So diversification is the concept of spreading your capital across different asset classes and investment products in order to reduce the risk of your portfolio losing overall value or to outperform a concentrated portfolio of few assets. But before we can fully understand the process of diversification, it is important to understand two key concepts related to it. These are correlation and risk. Correlation measures the extent to which two assets move in relation to each other. The correlation of two assets will be measured between 1 and -1. Assets with high correlation, who see their prices move in a very similar manner, have a correlated value of close to 1. Assets with low correlation that see minimal relation in price movements will have a correlated value of close to 0. And finally, negatively correlated assets, where the price of one asset increases as the other decreases, will have a correlated value of close to -1. Risk is a little bit more complicated, as it can be defined in many ways. Howard Marks states in his book The Most Important Thing that risk means more things can happen than will happen, with Investopedia adding that risk entails the possibility of losing some or all of your investment. Thereby, containing risk is crucial in investing, and diversification can be one way of protecting you against the risks of potential downfalls in certain markets. When you invest in different asset classes, such as stocks, bonds, and commodities, you will notice that their prices do not all move in unison. They do not all move together in the same direction at the same time. This is because they don't all have a strong correlation to one another. If your current portfolio is solely in stocks, these are all likely to have a strong correlation to each other due to the nature of the stock market and how their prices react to news updates, macro forecasting, and so on. So if there's a stock market crash, you will be overly exposed to a drawdown in stocks. As a start to the diversification process, you may decide you want to diversify the stocks that you hold. Here are a few ways that you can do that. You could invest in different industries so that you aren't exposed to just one. Seen in the tech bubble of the late 90s and early 2000s, for example, where many stocks crashed to zero. Also, you could invest in stocks located in different geographical regions to avoid a national stock market crash, such as the Japanese crash of 1986 to 1991. Now that you have diversified the stocks that you hold, you may decide that you want to add some bonds. Bonds can be a great diversifier, as they generally have a weak correlation to the stock market. Using a portfolio visualizer, short-term treasuries and long-term treasuries have correlations of 0.05 and 0.02 respectively to the total US stock market. meaning that if the value of the US stock market decreases, the value of bonds are extremely unlikely to decrease in the same manner, thereby limiting the loss to your portfolio in a stock market crash. You can add a variety of bonds to your portfolio, including treasuries, both long-term and short-term, corporate, international, and inflation-protected. You can also add a number of other asset classes. Gold and other precious metals can be added to your portfolio that are weakly correlated to both the stock market and bonds. Real estate investment trusts, commodities, and even owning a small amount of cryptocurrencies can be added to reduce the risk of loss if one asset class experiences a major downswing. This brings me on to Ray Dalio's holy grail of investing. In a short video published by Investopedia, Dalio explains the idea that the more uncorrelated assets you have in your portfolio, the greater chance you have at increasing your risk-to-return ratio. This makes sense, as the more uncorrelated assets you have, the less likely they are to all drop in value at the same time and crush the total value of your portfolio. The video is definitely worth the watch, so I will add a link to the description. Another investor who is keen on diversifying is the distressed debt billionaire Howard Marks of Oaktree Capital. Marks says that at his company, "We diversify to protect against what we don't know." Being diversified can protect you against the unknown forces that can tear into your portfolio's returns, making you less vulnerable to a surprise market crash. Taking Marks's advice, you can never be too confident in financial markets, as there may be a lot of hidden information that you simply do not know. But whilst Dalio and Marks are generally bullish on diversification, other investing titans do not share the same enthusiasm. William O'Neil, in his classic book How to Make Money in Stocks, states, "The winning investor's objective should be to have one or two big winners, rather than dozens of very small profits." Through diversification, you may spread your capital too thin across different asset classes, and as a result, you may only capture these small profits that O'Neil warns us about. Also on this train of thought is the Hungarian billionaire George Soros, founder of the Soros Fund Management and the man who co-founded the successful Quantum Fund. He has been quoted to say, "If the stock goes up, you buy more. You don't care how big the position gets as part of your portfolio. If you get it right, then build." Essentially, what Soros is saying is stick with your winners if you believe in them. Clearly there is a split on how popular investors approach diversification. It is up to you to decide which advice you follow and how you implement it in your own investing style. You may decide that you are a more risk-conscious investor who wants to minimize downturns whilst maintaining steady returns. Or you may focus on selecting few assets and hoping that they are true winners, pioneering your portfolio's results. Either way, diversification will play an important role on your future returns, and it is a concept in investing that cannot be ignored. When constructing your portfolio, it is important to remember the reasons why you are investing and meeting the financial goals that you have set for yourself. It is vital to invest in a manner that is most likely going to help you achieve these goals whilst meeting your risk criterion. If you have enjoyed the video and found it useful, please like, comment, and subscribe if you haven't done so already. We greatly appreciate your feedback and are eager to release more videos. Thanks for watching.